quickly and as efficiently. The idea with UPS is you do have a business where it is impossible, in my opinion, or virtually impossible for a newcomer to come in and scale up. It reminds me actually of something that there are a lot of businesses like that where you might have an easy barrier to entry at a very low level, but it's pretty incredibly difficult to come and compete with them. And the only person who's ever been able to kind of build this up in the recent memory is Amazon, and Amazon already came in with this scale. But essentially, you've got UPS, you've got FedEx, you've got DHL, and then you've got a few smaller competitors that are more regional or at a country level. And the idea is basically, not a lot of people have the balance sheet and time to replicate this because it takes a lot of time to build it. It takes a lot of expertise. And so this is a very safe business. It's a business where there are high barriers to entry. And this is a business where at the time that we purchased it, we thought that there is nothing fundamentally broken with it. And yet it was trading at levels where the market was implying that it is. And that was driven by essentially three things. The first thing that the market was worried about is Amazon's entry into the delivery business. And our view was that there is just so much volume coming from Amazon and others that even if Amazon entered the business, it wasn't going to completely take away so much volume that UPS cannot survive. We also believe that Amazon's volume wasn't particularly profitable anyway. The other thing is that at the time they had the big pension deficit that was worrying a lot of people. We believe that, I mean, not we believe, we knew that that was mostly driven by a low interest rate environment. And we believe that once rates reverted, that accounting deficit would be corrected. And then the third thing that people were worried about is essentially this idea that the whole online thing is already done and penetration is high, which we know not to be true, but that was the view. And so you've got this cash generative safe business that has the ability to invest, and not a lot of people can come and compete with it. And you can really kind of look forward many years and see that. So that it was facing a short-term perception challenge. It was facing a short-term accounting challenge. And we believe that with the arrival of new management at the time, not only are the two challenges going to be overcome, but we believe that there is more upside from better efficiency, better margins, and a better approach to managing the business. And that's what has unfolded so far.
And so we often talk about buying great companies that run great businesses. The third part we look for is that great valuation. So what prompted the decision to buy?
Hope you want to take that?
Well, for the year previous to owning it, it pretty much gone nowhere, and the same as FedEx. So and yet earnings kept growing, sales kept growing, and these worries kept persisting. And one of the things that's quite nice is when you start hearing people getting really worried about a business, that's often a really good time to start looking at it, because that's when the valuation is going down, but becoming more attractive. And if they're wrong, then that's your opportunity. So I think it was at about a 6% free cash flow yield, which is really pretty attractive, and for a great business. And we then looked at compared to FedEx. I think it was at about the same valuation as FedEx, but we just prefer UPS. It's got much better efficiency for the package to the more of the document delivery. It seems to have more pricing power, and it doesn't have the big fleet that airlines, well, not airlines, but aircraft that FedEx does. So it seems more attractive, and a year later it was sort of roughly where it was, but then the airlines it just took off.
Very good. Well, I was going to ask you about that. I mean, that seems to be a well thought out thesis. What actually happened once you bought it, and why do you still like it?
Well, I think shortly after we purchased it, they missed their earnings and the stock tanked. So back to what I said earlier about buying it too early. I mean, it was a temporary hiccup, and it was, in many ways, it wasn't a fundamentally negative outcome if you view things through a longer term lens. I mean, no business is going to be smooth sailing all the time. We're going to have some quarters that are tough, and I think Wall Street often overreacts. But I think when that happens at the same time that people are already worried about the business, and the market can really overreact negatively in the short term. That being said, since we purchased it 5 years, I think it's more than doubled. So the investment has done well over time for us, even though in the beginning I think it went a bit nowhere. There was a little hiccup along the way, but you own something long enough, you're gonna have quarters where the stock is down a lot, and you do things long enough, and you get used to it eventually. I think.
And it's still a position in the portfolio, correct?
Yeah, it's still. I think that's an any one day, but it's definitely one of our top five. We still think there's the growth picture has not changed. I think there's a lot of opportunity that's ongoing in terms of automation, in terms of whether it's how you run distribution centers or even how you run your fleet and routes. I think UPS is a big beneficiary of AI and other technologies. And so there's just a lot more room for this to run as a business for years to come, I think.
Okay.